Okay. Hello, everyone, and welcome to Stablecoins Are Killing It, episode number 7. I'm Lou Kerner with Crypto Mondays, now in VR, coming to you from Santa Cruz. We've got a great show for you today featuring Jason Jones with Centrifuge, Shuhan Zhu with Decentralized Finance Lab and Mirror, and Tom Meredith with BitMinutes. Each of our speakers are going to share their thoughts on their project and stables in general for about 10 minutes and spend the last half of the show taking questions from the audience. So if you've got a question, put it into Zoom in the Q&A tab. And if we choose your questions, we will ping you in chat. And then when it's your turn to ask the question, we will open up your audio and video so you can ask the question yourself and interact with the panelists. We are taping today's show, so we'll post it up on YouTube in a couple of days and write a blog post about the 5 or 10 lessons learned from the call. And with that, I'd like to start the call with Jason Jones. So Jason, you can now take the screen.
Okay, thanks, Lou. I will share my screen right now. Okay, do you see my screen?
Yes.
I'll take that as a yes. All right, thanks. Yeah, thanks for having me, Lou. Glad to be here. Glad to be on your show. Stablecoins Are Killing It with Lou Kerner. I like the name of it. Okay, so I work with the Centrifuge project. And for everybody on the show here, Lou and I go way back to when we were young pups, kind of just getting out of college and working at, we worked at Goldman together way back in the day as analysts. So our paths have crossed over the years, and glad to be back here with you doing the show, Lou. All right, Centrifuge. Centrifuge bridges real-world assets to DeFi, and I'm going to show you how that works. Our chain is called the Centrifuge chain, and our dApp, which sits on top of our chain, is called Tinlake. I'll go through that in a second. So first, a snapshot of Tinlake. So if you go to tinlake.centrifuge.io, this is what you will see. Currently, we have two pools available. We just launched last month. Right now, we have 2 pools available for investment. One is Console Freight Series 1. The other one is Paper Chain Pilot. Actually, Console Freight Series 1 has already raised the money. It's already deployed the money. It's already paid back the money. As you can see here, it paid back $280,000. Paper Chain's just getting going. They deployed the first $2,000 yesterday, actually. They're just getting going. And next Tuesday, we're going to do Series 2 for Console Freight. We'll raise another, looks like it's going to be about 350,000, 300 to 350,000, somewhere in that range. We'll announce that next week, and you'll see that up on our site. So as you can tell, we are very focused on asset originators, and we help them bridge their loans or invoices into pools and get them tokenized and financed by DeFi. Different types of asset originators. There are the non-bank lenders like Console Freight and Paper Chain, which I can go into a second. There are banks, and then there's embedded software companies like an SAP or Salesforce, or even a Square and Amazon that may lend to their merchants, a Uber that may lend to their car drivers. In all those cases, they are more software plays that also have the ability to, their proprietary data that they can lend to their borrowers with. Right now, I'll talk about the non-bank lenders, since that's where we're starting. Both Console Freight and Paper Chain are non-bank lenders. They, in the case of Console Freight, they help shippers who are purchasing freight forwarding or purchasing carriers from freight forwarders. So a supermarket that needs delivery of cargo for goods for their supermarket may purchase a carrier from a freight forwarder. And in the case of Paper Chain, we're dealing with musicians who have streamed their songs on Spotify and are waiting to get paid by Spotify. In both cases, we're talking about goods or services that have already been delivered, and we're just waiting for payment from the buyer, typically 30 or 60-day payments. That's where we're starting. Very short duration, very safe types of investments. We're tokenizing those invoices between the buyer and supplier. So our Centrifuge chain is designed for asset originators. The asset originators come to our chain. They import their assets, those assets being loans, invoices, warehouse receipts, any type of kind of payment obligation. Could also work with a commodity like a hard asset like a gold or a home. In any case, we take the assets, business documents, we tokenize those business documents. We create an NFT out of each one of those business documents. Every single loan, every single invoice gets its own token, its own NFT token. We then take a large pile of those NFTs created by one asset originator, and we put them into a pool. We do that on Tinlake. So Tinlake pools up all those NFTs into one single pool and then makes that pool available for lenders. Okay, so when we talk about MakerDAO, so we're talking about stablecoins here, we're going to talk about how the lender, in this case, the lender on the right-hand side, we're going to talk about a stablecoin issuer, specifically MakerDAO, and how we're building our systems to adapt with the Maker vaults. So here goes. Here is my Maker vault. I'm sure your audience is very familiar with Maker vaults. Just to give you a quick overview, in this case, in the bottom left-hand corner, I have 10 ETH locked in my Maker vault. That's worth about $2,000. Of that $2,000 in collateral that I've locked into the Maker vault, I have withdrawn 596 DAI. Right? I have the ability to withdraw another 959 DAI, but so far I've only drawn 596. That means my collateralization rate, which is the is 391%. That is 391% of 596 equals 2334. So I'm way over collateralized in the amount of the loan that I've drawn based on the collateral that I've inserted. If that collateral ratio dropped below 150%, which is the minimum collateral ratio, then Maker would be forced to sell my ETH. Right now, I'm way over collateralized, so the chances of that happening right now are pretty minimal. When I borrow this money, this DAI from Maker, I'm borrowing it currently at 0%. That's the stability fee right here. So I'll put up ETH and I've borrowed DAI. I need to now pay back that DAI. When I pay it back with interest, in this case, the interest is 0%, they will unlock my ETH and I'll be able to take my ETH back. So I've basically got a loan from MakerDAO for my ETH that's locked as collateral. Okay, so what's going on with Maker? Let's talk about Black Thursday for a second. Back, what was this? March, we had a Black Thursday event, which I'm sure your audience is familiar with. In this case, there were close to 4,000 Maker vaults that were liquidated within 24 hours. There are many reasons why that happened. We don't need to go into all of those details. The one specific one I want to go into, though, is the concentration risk. 99% of all Maker vaults are backed by ETH. And in this case, ETH crashed. And when ETH crashed, 4,000 of those vaults crossed the minimum ratio of 150% and therefore were forced into liquidation. It all happened at once. That's concentration risk. The only type of collateral in Maker was ETH. ETH's volatile, ETH fell, and a lot of liquidations happened all at once. That's one of the reasons why Maker wants to push forward with multi-collateral Dai, to have different types of collateral that back the Maker vault. So in May, or actually early June, well, throughout May, they had what's called a MIP6 proposal. These are different types of collateral assets that have been brought forth to MakerDAO, so the community could vote on what types of collateral they would like to include in Maker as new types of collateral to back a Maker vault. In our case, we submitted 2 applications. One was with PaperChain, this PC drop. The other was with ConsenSys, CF drop. Our two are two of the few real-world assets as collateral that were introduced into MakerDAO. You can see some of the others here are well-known: Phantom, Decentralized, TBTC, Uniswap, so 0x, so a bunch of ERC20 tokens and other traditional tokens. Ours are a little different because they are real-world assets that have been wrapped into ERC20 tokens. And you can see over on the right here that the community was heavily in favor of our assets, voting 97% voted for PaperChain, 97.7 voted for PaperChain, 96.9 voted for ConsenSys. So in both cases, we had great community support, which means that the domain teams and Maker are now digging into our assets and will do the due diligence and determine, get into the details, and then finally determine whether these assets are appropriate for Maker as collateral. That's the process we're in now. We don't know when we don't know the timeline for deliverable of a final verdict will be, but we just know that they're working on it now. Just to give you a sense of what this means, in the ETH collateral DAI, you put 150% of ETH in, you withdraw DAI. Currently, the interest rate is 0%. With our system, we're basically saying, okay, let's take a pool of Spotify invoices. We'll break that into a senior tranche and a junior tranche, which are called drop and tin. The junior tranche, we will have PaperChain, the asset originator, invest, and the junior tranche takes the first losses. So that's a layer of insurance that you can think of. We then take the senior tranche, the drop, and that's what we put into MakerDAO. And the senior tranche doesn't need the same over collateralization of ETH. Number one, because it's not as volatile as ETH. Number two, because we have a layer of insurance on the bottom. And therefore, maybe there's a little bit of over collateralization. We haven't determined exactly what that level will be yet. But we'll put the drop into the Maker vault, and we'll take a loan against that. And in this case, the other thing is we'll take a loan, maybe 6%, maybe higher, I don't know, but it'll be higher than 0%, which is what is being charged right now for ETH collateral. So this is a new way of increasing the circulation and stabilizing the MakerDAO DAI stablecoin. And that's all I have. If you need to reach me, jason@centrifuge.io.
Okay, terrific, Jason. Can you talk about what it's been like interacting with the Maker governance?
Okay, so you broke up a little bit there, but I'll repeat your question. Can you talk about what it's been like to interact with MakerDAO governance? It's been a super interesting experiment. MakerDAO is currently decentralizing. You have these, in the beginning of April, Rune and team put forth their plans for decentralization, and they basically made three components. They made, the first component was that the domain teams would decentralize. So each domain team, there's an application process to become a new domain team. Domain teams can do things like evaluate collateral assets, look at risk, think about marketing. It's an Oracle domain team, a bunch of different domain teams that will be decentralized. The second component is the MIPS process, the Maker Improvement Protocol process. And that's where you can submit changes to, the Maker Improvement Protocol. For instance, if you have new collateral that you'd like to introduce to Maker community, you create a MIP application. It's like a loan application that then gets evaluated by the community and due diligence by the domain teams. The third component is delegation of votes, where you, as the Maker voter, I have the right to vote on all sorts of polls and executive votes that are coming through Maker. That may be a little overwhelming for me. I may not have the time or the skills to do that. In that case, I can delegate my votes to a third party who can vote on my behalf, kind of form a voting block. So those are three components that were introduced. So far, the system is it's moving from theory to reality. So they wrote down, they got very detailed on theory, and now as it kind of goes to reality, they're making tweaks here and there to how the process works. But overall, the process is working generally as expected. So all the pieces are lining up right now, and it's just really interesting to see this whole decentralization process take place in front of us.
Well, that's exciting to hear. So thanks, Jason, and thanks for sticking around for the Q&A session afterwards. And next, we've got Shihan Zhu with Decentralized Finance Labs and Meter. Shihan, you can take the screen now.
Okay, thank you, Lo. And let me share my screen. Give me 1 second.
See the green tab at the bottom, screen share?
Yeah.
There you go.
Yeah. So yeah, thank you for the opportunity. Just want to spend the next 10 minutes talk about like our philosophy and our approach to build a different type of, I would say, crypto native money, essentially. So basically, we started this journey for like from Bitcoin to create like a peer-to-peer electronic cash, right? But Bitcoin, at the end of the day, becoming more and more like a peer-to-peer electronic gold instead of like the money, because it's more like because of the limited supply, making it more like a store of value type of asset. So right now, so far we have been.
If you can you make the on the view, if you put into the presentation mode, then it
Sure.
takes the full screen.
Let me do that. Yeah, so far we have been using like an application approach to build money. Essentially, there are 3 different types of popular approaches, but they all have their own like intrinsic issues. For example, just now we mentioned MakerDAO, which is like a crypto collateralized like a stable coin. So the main problem is the capacity issue. So when they're using certain collaterals, they can only use a very small percentage of that asset as a collateral. Otherwise, in a liquidation scenario, just by liquidating the collateral in Maker will cause the entire asset class to collapse. So that's obviously will limit the capacity. So I believe like with ETH, the Maker already set themselves to be around 100 million to 150 million capacity. By introducing real world assets, they could increase more capacity. But even with that, there's still another issue for oracles. So basically, most of the Oracle approach are still centralized. And also, Oracle is more like an enterprise software layer of the security. Essentially, you can build products on top of it. But if you build a financial system on top of it, it could be too much of a risk for a system. Because any software, I mean, if there's a failure, I mean, no one can guarantee 100% always on, always correct for any software, right? So if anything fails in an Oracle, if it feeds wrong data into the system, it could cause the entire system to collapse. So, and there's other algorithm-based approach. We don't believe this approach works because in this approach, certain type of players most often get the currency for free, and the other participants have to pay an arbitrary amount, let's say $1. So it's very difficult to reach consensus on what exactly is the value for the underlying currency. And then it's finally the fiat-backed approach. Everyone is familiar with it. So there's more a centralized solution with regulatory and also basic counterparty risk. So if you look at the problem, it's essentially international finance problem. So we have a crypto world and we have a physical world. The crypto world basically is selling financial products to the physical world. And the physical world is essentially exporting computing and energy into the crypto world. And the interaction between the two economies, just like two real economies, you have to follow the famous international finance rules. So basically, if you look at the link between the two worlds, the only link or the most the strongest link between the two worlds is actually proof of work mining. Essentially, for the miners, they are all profit driven. And in such a competitive environment, at the end of the day, marginal revenue equal to marginal cost, actually. So for the miners, their marginal revenue are all in the crypto world. It's a block reward, there are the transaction fees. And their costs are all on the physical world. Basically, there's CapEx for purchasing the mining equipment, and there's OpEx for the electricity cost. And at the end of the day, because the competition is like so fully competitive environment, basically the marginal revenue will essentially be the same as the marginal cost. If we will using the hash rate as like proxy for the energy spent by the miners in the system, you could already see basically this chart, basically the top one is Bitcoin, the bottom one is Ethereum. So you could already see the price of Bitcoin and Ethereum have strong correlations with their price, with the price, right? Which is pretty obvious. But different mining hardware actually have generations of energy efficiency. If we adjust that for that, we actually run, I deleted that slide. But basically, we actually got like 85% correlation between the adjusted hash rate with the market price of Bitcoin and Ethereum. And majority of the deviation happens only in 2017, when at that time basically there's a lot of major forks going on for Bitcoin. So by looking at this, basically we're just rethinking about how do we design the economic schemes of cryptocurrency. If we create a cryptocurrency which has fixed cost of production in terms of electricity cost, we can actually create a low volatility crypto native currency. So which is packed to kilowatt hour electricity essentially. And we realize this is actually a really stable index in terms of purchasing power. So this chart shows the competitive electricity price based on the top one, the brown line shows the price of electricity based on US dollar. From 1960 to now, the price went up almost 6.3 times. But the blue line is after the price got adjusted by inflation. They essentially stayed the same during the whole period. This is actually more stable in purchasing power than any fiat currencies out there. So the other thing is, if you look at all the existing cryptocurrencies, there are actually two consensus going on in the system, and people probably didn't realize them. So the first consensus is the record-keeping consensus is to prevent double spending, and this is basically Bitcoin's white paper is all talking about this. But there's another consensus which is implicit. Basically, it's economic consensus. It's like how much new value has been added to the system and what's the value of newly created coins. So this consensus is done by the proof of work miners in a proof of work consensus. But there's no such consensus in a proof of stake system. So people are only focused on record keeping side. So that's a thing we believe that's missing in just traditional proof of stake. And the way we designing it is we separate the two consensus. So in Meter, basically we have a two token system. The first token is a currency token. Basically this created by proof of work with 10 kilowatt hour of electricity in proof of work mining. So based on our calculation of historical result and cost parity of mining Bitcoin, we estimate the equilibrium price will be a little bit lower than $1, but basically in that ballpark. And basically miners will be, miners' profit chasing behavior will naturally create feedbacks into the system. Basically, if there's more circulation needed, the price of the coin will go up. Miner will have higher profit margin. They will have more incentive to mine. When the price drops, miner will have a less incentive to mine, and removing their hash power, the entire production of the coin will get less as well. And then we use proof of stake to basically do record keeping. So basically, yeah, this is how our consensus is designed. Basically, by doing that, we can actually merge the benefits of both worlds. So one of the major complaint, for example, for proof of work is waste of energy, right? But that's because of the hashing power in Bitcoin, for example, directly correlates to the price of Bitcoin or the total market cap of Bitcoin. But because in a meter type of system, the hashing power only correlates because all the value of the coin are the same, and also they are stable. Basically, the hashing power only correlates to the increment of market cap instead of the market cap itself. We actually did calculation in order to support a U.S. economy type of size and growth. The amount of hashing power needed in the system, the annual cost of mining is similar to the annual budget of US Mint and US engrave and print. So it can be as efficient as fiat. And because of proof of work mining, everyone can be the central bank, can create currency. So the entry barrier is really low, but you can not cheat. And when using proof of stake for record keeping, we can have like fast performance and high fast finality. And also we can like avoid some of the issues in proof of stake coin distribution. And also the security issues for long range attack, for example. So yeah, so basically right now the status of Meter is we're launching this month our mainnet. Basically we're looking forward to basically the experiment the new like economics and the game design in the real world. Yeah, thanks a lot for the opportunity.
So thanks a lot. What's in terms of the timing, kind of what are the main things that you need to accomplish before you roll it out?
So basically like it's more about the technology because we are like basically merging essentially like a Bitcoin type of proof of work mining. And also we're using a new consensus design that's very similar to Facebook Libra. It's called hot stuff consensus. So basically all of these things have to work together properly. Yeah, it just takes a long time to like make the technology stable essentially. And now basically when we launch to the real world, it's more about creating liquidity. So basically we're like actively discussing with like exchanges to get the tokens traded and with basically liquidity strategy initially to basically boost the volumes and people's interest essentially.
Okay, and I know that you've been developing this for quite a while.
Mm-hmm.
And what's the biggest lesson learned during the time that you've been developing Meter?
I guess the biggest lesson learned is this crypto world evolves really fast, right? So because you're building something as a builder, I mean, it always takes time to build, but because overall market sentiment and also focus is always changing. But because we're just believe there's a fundamental need for such technology and such approach, that's what basically pushed us to work on this for so long. Because we want to finally be able to test it out in the real world. But I mean, for another new startup, I would say, I mean, especially at this stage, I mean, just basically try to iterate with the customer as early as possible.
Okay.
Yeah.
Terrific. Thanks, Johan, for sticking around for the Q&A portion as well. And now we will turn it over to Tom Meredith. Tom?
Hey, good afternoon. How are you, Lou?
Good. So you, I guess you're on your mobile phone, so no slides today.
No slides today. I was hoping to get back to the ranch in time, but couldn't do it.
Okay, and I'm not sure what we're seeing your Mercedes, I guess, on the video. So I guess no need for the video.
Well, is that better? I can't see what. Okay. If I flip it around there, does that flip?
Okay, it's fine. We just stopped the video. But so why don't you tell us about? Oh, there you go. Now we can see you.
Okay, cool.
That's good. So why don't you tell us about BitMinutes?
Yeah, BitMinutes is a concept to create stable coins in various countries that we do business in. Right now, we're live in 13 countries, and we just recently did a deal with Prime Trust that will allow us to expand globally to create a stable coin in all the major countries that we're looking to operate in, to create a network of agents to allow e-commerce to the various countries, thus bringing, call it a US dollar for every country that we're working in. So for instance, in Nigeria, we're issuing what we're calling a bit naira, which enables us to tag the bit minute directly to the naira currency to allow for e-commerce and allow agents to be able to use a form of purchase electronically to buy goods and services. And doing so, we're also creating jobs for what we call trusted agents that will enable people to buy and sell crypto using Naira in their native currency. But again, that's called the BitNaira, which is backed by BitMinutes, which is prepaid phone time. So a lot of moving parts there. So that's the 10,000 foot level, and happy to drill down because it's the same country model over and over and over again. What we're seeing here is that people want to be able to buy Bitcoin. We give them an avenue to do so. And by turning their local currency into electronic currency so that they can buy BitMinutes as BitNaira, or in the case of Guatemala, we're launching as well, they can buy BitQuetzales. And we're going to be doing, now that we've got this prime trust deal, we can also do it down here in the States legally, where has been the big impediment for us to launch here in the States. So same concept over and over, is that we create a electronic version of the local fiat, back it by prepaid phone time, so it's something that can always be converted directly into local currency and be used as local currency. So it's not something that's fluctuating, it's actually a stable coin in that country.
And so what country are you kind of, do you have the most traction in at the moment?
Right now it is in Nigeria, where we basically have approximately 1,300 agents. I think we're pushing 7,000 customers, and they're using it primarily for prepaid phone time, which is obviously that's what the BitMinute is used for. So we sell it at a slight discount to be competitive and to encourage the use of BitMinutes. But we've just recently added the ability to buy Bitcoin, because we saw a lot of demand, and the agents were asking for it, because a lot of these agents are people who are local merchants, and that's our whole concept of turning the local, the corner retailer into the corner banker, by then allowing that person to use BitNaira to make purchases, not only with that merchant, but also to buy things online. We're going to be adding a virtual MasterCard option here soon. But we heard there was a tremendous interest, and we know of other competitors who are selling Bitcoin in Nigeria. We're not a big fan of Bitcoin because, again, it's not good because of the volatility for a payment system. That's where we feel that BitMinutes backing an e-fiat in each one of these countries makes sense, because there's value, instant value, convertibility from that e-fiat that we're creating, the BitNaira, again in Nigeria. So it brings a lot of validity by having something that's tangible that a consumer can use immediately, so that it is backed by something, and then that will convert back into Naira at any one of these merchants, either in cash, or we're connected to all the major banks in Nigeria. So does that answer the question?
Sure. And have you seen much activity in terms of acquiring Bitcoin?
Well, we do know that our competitor over there has been doing very well. They went from 0 to $1 million in sales within, I think, 4 or 5 months, which is what was the impetus for us to offer this as well. But we literally just turned it on today. We tested it with the test case with our processor over there, and we literally just turned it on. So, right now, no traction, because today is day 0. But we anticipate, I think our lead developer, or let's say our lead liaison over there, she estimates that there's like 2,000 people that would buy this product if we had it. So that was the impetus also, again, for us to create it. And the beauty of working with Prime Trust at this point, we're not just constrained to selling these e-fiat coins backed by BitMinutes in just about any country, because they take credit cards on a global basis. So we've been working with processors and licensed vendors in each one of these 13 countries we're live in, but now we can do it on a global basis from a US-based company to be able to sell BitNaira or BitQuetzales, or in Lebanon it's the pound, Egypt, we could launch in any of these countries by selling Bitcoin, but better yet, using their local currency backed by BitMinutes as a vehicle for doing so. So in some countries, Nigeria is kind of a gray area, but some countries don't allow you to use processing, credit card processing, to be able to buy things. So they buy BitMinutes, and then we can convert it because we have that capability inside our wallet. We've actually put convertibility and like making an, let's say, call it a mini exchange inside the wallet. We're calling it an atomic swap because it's actually done inside the wallet. So a lot of different new technologies that we're combining to leverage the whole concept of an e-fiat or a stable coin in each country, backed by something tangible and usable, i.e. the BitMinutes themselves, the prepaid time, and then bringing that person, that underbanked person who is our target market, bringing them into the e-commerce world and to be able to do things like buy Bitcoin if they care to, or to convert or move their money into a different stable coin, our USD stable coin we're about to release now that we've got this deal with Prime Trust in place.
Okay. Well, terrific. Well, thanks for that, Tom. Certainly very interesting and very different from anything, at least that I've seen out there in the marketplace. And so thanks for sticking around for the Q&A session, which we're going to start right now. And our first question is from Miklos. Miklos?
Hey, guys. Hello, everybody. Thank you for all the presentation. I enjoyed really. So my first question is to Jason. That so what do you expect that banks will be engaged or will be buying up these collateralized invoices, or where do you see who will buying up or doing this actually? Because banks used to have a separate department for doing factoring and buying up collateralized invoices or just invoices.
Thanks, Miklos. Yeah, I said at the beginning that there's three different types of asset originators. There's the non-bank lenders, there's the banks, and there are the embedded software types of companies. In trade finance, working capital finance, factoring, whatever you want to call it, supply chain finance, the banks have dominated that sector for years, and it's a very profitable, very large segment of what they do. Over the last kind of, I don't know, 5 to 10 years, I'd say the fintech market has slowly opened up that market, and you've seen most of the fintech companies have focused on the supply side, the suppliers. So they do factoring. Companies like Fundbox or Bluevine are two good examples of fintech companies in the U.S. that have tackled the supplier side. Companies like C2FO and Taulia have tackled the buyer side, and in both cases, they've kind of opened up this market to companies beyond banks. And I think we can go further and bring that to the blockchain with Centrifuge. And actually, the co-founders of Centrifuge are previously the co-founders of Taulia, so they have a lot of experience in cracking this market open, and will continue to do so.
Okay, nice.
Jason, what's Taulia? What was Taulia?
So Taulia is they raise like 300 million. They do about 20 billion in transactions per year, and what they do is they work with Fortune 1000 buyers like Walmart, Costco, like big time buyers, and they interface with their tier 1 suppliers. So Walmart buying Nikes, right? So what they provide, they started with dynamic discounting, which was a negotiated transaction between Walmart and Nike on, hey, if you don't want to be paid in 90 days, you want to be paid in 60 days, this is the discount that we'll offer you for that. Once they determined the discount, then they said, okay, well, Walmart doesn't really want to finance that on our own balance sheet, so we'll bring in a third party to finance that. So it was the beginning of supply chain finance done through technology. That's the dynamic discounting side. That's what Taulia does. They added supply chain finance after that.
Wow, super interesting. Okay.
Yeah. Cool. Thank you. Just one more question. That how do you see that retail investors like DeFi investors will just catch up and then take this opportunity, or how do you see this?
Yeah, so we're starting with, we're taking this massive category and we're breaking it down into chunks of 250,000, 300,000, and opening it up first to just individual investors, individual DeFi investors that want to invest directly into a pool of, Spotify invoices. But we're getting very close, like I mentioned, to using Maker as a financer for us. And in the case of Maker, they are the capital that would come into the pool. Instead of an individual investing, Maker would be the investor. And the other side of that is an increase in DAI circulation, right? So it's helping increase the whole stablecoin market.
Ecosystem,
But will also be available, our tokens will also be available for purchase beyond just Maker as well. So individual DeFi investors will be able to come to Tinlake, or we may distribute it through other DeFi platforms as well, where people can access the Tinlake tokens.
Thank you, Jason.
Thanks, Miklos. Our next question is from Ganesh. Ganesh, need to unmute.
Hi, everyone. I'm a lecturer at Warwick Business School, and I'm researching stablecoins. So my question is to Jason. So just wanted to ask a little bit more about your last slide. When you talk about this multi-collateral Dai, and then you have these tranches, and how this extra collateral on Tinlake kind of reduces the chance of, or like sort of concentration risk happening. So could you explain that a bit more? And I was just curious, in this recent expansion of multi-collateral Dai, how common is it for users to be using these kind of tranches of collateral? Is that quite common now since they moved from single to multi-collateral Dai?
Good questions, Ganesh. I'm going to share my screen if you don't mind, and show you just another view into that, just a slightly different view, but similar view. Host disabled participant. Oh, I can't share my screen, Lou.
Yeah, you can share it now, Jason.
Okay. Oh, there we go. Okay. This is just basically another view into this tiered senior junior tranche. And basically with any securitization, you're basically taking a payment stream and you're dividing it in two. And you're making the senior tranche a lower, safer interest rate, and the junior tranche a higher return, but also higher risk interest rate. So in this case, you have $60,000 with a 7% interest rate, where the senior is 90% of the tranche, that's the drop, and the junior is 10% of the tranche, right? Actually, this is a little bit more than that, but you see the breakdown there. We've taken that 7% interest rate and we've broken it up into a 5% interest rate for the senior, which is a fixed interest rate, and then the junior is the residual and gets the rest. So, so if the senior starts at 42,000 and they get a 5% interest rate, they're going to generate 2,100 in Dai, right? 5% fixed rate. Junior starts with 18,000. Let's say there's no impairments here, there's no defaults in any of the loans. They get 7% on their 18,000, so they get $1,260. Plus, they get the difference between what would have been paid to the drop. So, so the drop would have received 7%, but they're only receiving 5%. So that difference, that 2% difference, will flow to the junior tranche, so another $840. So for total interest is $2,100. That ends with $20,100, 12% return. So basically split this 7% payment into a 5% payment and a 12% payment. The risk, though, is if there are any defaults, this impairment right here, this zero impairment, it will all go to the junior tranche. So that 12 will get impaired while this 5 remains very stable, right? So all we're trying to do here is make a very stable senior tranche that has very little volatility. So only the senior tranche is actually introduced into the Maker Vault, right? So we're introducing a very stable source of collateral to the Maker Vault. It's being backed by this junior tranche, which is outside of the vault, but it's still protecting the senior tranche that's in the vault. So that's a new concept that, I mean, this securitization concept is not new. this is very, very old and very established in finance. Putting this concept into DeFi and specifically into MakerVaults is a new concept, and that's something we've built on chain.
Yeah, was it the mortgage security industry based on this?
Tom, could you say that again?
Yeah, wasn't the mortgage-backed security industry based on this approach?
It was, yeah. And it basically, what we're thinking about and what you're thinking about, Tom, is very similar in the fact that we both believe that money should be backed by collateral, stable collateral. So both what you're doing and what we're doing serves the same purpose. Get something stable behind your stablecoin.
They're in the name.
Yep.
Okay, Ganesh, you're good?
Yeah, it's good. Thank you.
Okay, Ganesh, our question is from Anna. Anna?
Hi, so my question is to Xiaoan. I hope I pronounce your name properly.
Yeah.
Could you please elaborate on the cost of production of Meter? I understand you're saying that the cost of production of Meter tokens are consistent, and also that the hash rate is kept to be strongly connected to the increment of market cap, unlike in Bitcoin, for example.
Instead of market cap itself, right? Yeah. So basically, first question regarding to how we link the production to the hash rate is actually like it's a probabilistic approach essentially. So basically, you can, for example, in Bitcoin, each block's production is always right now like 6.5 Bitcoin per block, right? It's a fixed reward. But in Meter, basically, the amount of block reward basically directly correlates to the total hashing power of the network, and it's adaptive essentially. It changes block by block based on the hashing rate. So we have a feedback algorithm. Essentially, it makes average of creating a coin. The number of hashes needed on average to create a coin stay the same. Just like a Bitcoin, there's an algorithm for like the block period to be like 10 minutes, right? We have a similar feedback algorithm to make sure the amount of hashing needed creating for each coin is staying the same. And also as the Bitcoin mining hardware efficiency improves, it's actually because right now everything is ASIC is already pushed to the we would call it the efficiency frontier, essentially. So basically from here to now in the future, it's more like following Moore's law type of approach. So we have an internal building curve that simulates the Moore's law type of like efficiency improvement. Basically every 18 months, the efficiency like basically improves. I mean like the amount of energy needed for the same number of hash operations decreased by like half essentially. And also there's a governance mechanism to adjust this like on a 6 months basis if it deviates too far from it. And regarding to why it's linked to the increment of market cap instead of market cap itself is like, because just now we mentioned like in Bitcoin, the supply is fixed. Every block, there's a same amount of supply adding to the market. When the economy grows, the new value need to be represented in the system, right? If the supply of the token representing the new value is fixed, the only thing you can change is the price. But in Meter, because the price of each coin is essentially stay the same, but the miner corresponding to the basically reflects the new value by changing the quantity supplied to the market. So basically only the quantity changes. So only the newly created value need to go through this proof of work process and need to create new quantities of the same value token to represent the real economy growth, essentially. Does that make sense?
Yes, thank you.
Mm-hmm.
Okay, thanks, Anna.
Thank you.
So I will take the question, and this is for all of the panelists. We recently passed $11 billion in total market for the stablecoin ecosystem. If we're looking, let's say, a year from today, where do you think we will be in market cap? And what are the things or thing that you're looking to happen in the next year that you think will surprise you to people on the call today? And with that, why don't we start that with Tom, then we'll go to Shuhan, and I'll let Jason have the last word. So Tom, where do you be in market cap a year from today, and what are the other things that you're looking for in the stablecoin marketplace that you think would be a surprise to?
So the question is, what the future of stablecoins in general, or?
Yeah, just as you look at stablecoin ecosystem, we recently passed $11 billion in market cap, and just trying to get people's thoughts on where you think we'll be in market cap a year from today. If there's one other thing that you think that will happen in stablecoins that you're looking for, what is that?
Well, if you broadly define a stablecoin to be something representing a fiat currency in any country, I think the number is going to get very big very quickly. Right now, I think the definition of a stablecoin is primarily referred to as U.S. dollar stablecoins, with, of course, Tether leading the way. But for the most part, I believe that it's going to be it's going to really broaden out, and that's the market we're playing in, is creating stablecoins for various other currencies. I know that the USD stablecoin industry will expand. We're launching our own, of course, for our customer base. But for the most part, that will continue to grow. I imagine that the growth rate itself will start to slow in the USD space, but that it will explode in the Euro space and the other 5 top major cryptocurrencies, fiat currencies globally. And then followed, of course, by the various, let's say, startup economies, or let's say the developing world economies, as they become more and more, let's say, e-fiat friendly or crypto friendly. So USD will expand, call it maybe a doubling. So where do you say we're at now? 11, what billion?
11 billion, yes.
That is an amazing number. So I can imagine that that's going to at least double over the next 1 to 2 years. So get it up to 20 billion. And then you're going to see the euro come up, probably around 50% of that. So add another 10. And you got China coming to there. So if you count China, and if they go as full bore as they say they're going to on creating a digital currency, I think it's an arms race. So you're talking easily $50 billion worth of stable coins if you broaden the definition beyond just USD.
Okay, thanks, Tom. And yes, I would definitely, and obviously the one of the problems of any new industry like stable coins is just the nomenclature and what we mean by words. And so, I would define stable coins as, thinking about bank digital currencies like the China's DCEP, that CBDCs are a subset of stable coins. And so, I think of the definition as being very broad. So with that, Shuhan, what are your final comments and thoughts on where the market will be?
Yeah, so I definitely feel like a stable coin is the future, but I think just my personal opinion, we still have quite a sizable growth potential for the fiat-backed stable coin. But I think at the end of the day, these central banks game. So right now the stable coins are like Tether, like USDC, like USD, like those type of things, or like DAI. But I think as long as they are fiat denominated, at the end of the day, as things gets bigger, regulators, central banks, they will all come in. If you look at how they regulate like traditional banks, you will see the future for the privately issued stable coin in the future. So things just going to get more and more strict. And So I think that's why basically we set out to create this like a new type of currency, essentially type of approach. And I mean, we don't feel it's gonna be like immediately like competing head to head with the stable coins, the fiat-backed stable coins out there, but it provides an alternative for the crypto like ecosystem.
Okay, terrific. Thank you very much. And the final word will go to Jason.
All right. So I had the most time to think about this. I would say that it all depends on China, right? So depends on how much China's CBDC gets launched, right? It could be without that, you're at like 20 to 50 billion. With that, you could be at 50 billion to 500 billion. Who knows? It depends on how quickly China kind of launches that CBDC, and that could swamp the stablecoin market. I think the bigger question here, or bigger kind of observation, is that the world is not really ready for what's about to happen in the next 2 to 3 years, where stablecoins are going to be everywhere. They're not thinking about that. So I think we're going to wake up in a very short amount of time and realize that stablecoins are money. They are money, and they're programmable money. And it's going to get really interesting really fast. And a lot of people will get caught flat-footed based on that. But like you say, Lou, stablecoins are killing it.
Okay, well, thanks for that, Jason. Thanks, Tom. Thanks, John. Great show. Thanks, everybody who dialed in, and look forward to seeing everybody on Stablecoins Are Killing It, episode number 8, next Thursday, PM EST. Thanks, everybody.
Thank you.
Thank you.
Thanks, Lou.